You're watching Portfolio Makeover, an original series from ETF Guide TV. I'm Ron DeLegge, and today we're going to examine a $686,000 retirement portfolio for TB in Tucson, Arizona. And I'm going to tell you what I like about it, what I don't like, and what can be improved. Now, before we introduce everyone to TB and take a look at her portfolio, I wanted to share with you a poll that was taken recently on this very channel. And this was kind of trying to get a glimpse at what were people's biggest regrets over the past year. And you can see number one regret, owning too many of those high-risk, volatile growth stocks. Over 40% or just about 40% of the audience or respondents felt that they had too many of those types of stocks in their portfolio. But look at number two. The top response was, my portfolio didn't have enough cushion. That was 33% of respondents. And I just want to congratulate the audience for recognizing the importance of protecting capital, especially as we get into retirement or get close to retirement. That cushion should be bigger. And the reason it should be bigger is because as your time horizon compresses, you have less time to recover during a deep or severe stock market drawdown or when financial markets are acting squirrely. And so that's why it's so crucial to protect your nest egg. And that's why you've been hearing me talk about having an adequate cushion, or what I call margin of safety. That's going to be a reoccurring theme on this channel for time to come. And I will continue to evangelize that very, very important message. So many investors are flying by the seat of their pants with absolutely no protection at all. And it's pretty incredible. But anyway, again, congratulations to you, the audience, for recognizing the importance of having an adequate cushion. So let's talk about TB, who lives in Tucson, Arizona. I haven't been there in a while. I think the last time I was there, it was spring training. I was seeing the Chicago White Sox, and I don't even know if they have their spring training facility there. I haven't checked. It's been a while. But she's got $686,000 inside a 401k plan. She's 63 years old. She's single. What a catch. And she's in the healthcare field. And then her money's being managed with the help of an investment advisor. She considers herself a moderate risk taker. She's making maximum contributions to her 401k plan, so that's good. She's a disciplined saver. She plans to retire in just a few more years at age 70. That's also when she's going to take her Social Security, so she'll be getting the max. And then she's in good health, and she's got longevity inside her family genes. So some big concerns for TB. She's not sure about her portfolio's asset mix, which is kind of surprising to me because you got an investment advisor. So it seems to be like, is there some trust issues there with your advisor, or maybe some communication issues? I don't know. Taxes on her RMDs, she's not too clear on that. We'll explain that in a second for you, TB. And then she's also concerned with longevity in her family line of outliving her money. All legitimate concerns. So here's TB's retirement portfolio. It's broken down into 4 different Fidelity Flex Index funds. Those are the ticker symbols. And you can see her current portfolio yield just over 1.7%. Really highly correlated portfolio to the market. 1 would be a perfect correlation. She's just at 99. And then she did have some unrealized losses on paper, a 17% drawdown from February to September of 2022. This portfolio has since recovered a little bit. We'll take a look at the performance in a second. So we do this portfolio makeover category by category. I think it's a real unique feature of this program. We look at the risk of the portfolio, the taxes, the cost, the performance and diversification, all the factors that are crucial to a well-built and architecturally sound investment portfolio. So the question is, which category are we going to start with first? Let's spin the wheel to find out. All right, so let's start with taxes. And as you can see, there's only 3 places where everybody's money can be located. It's in the tax me now bucket, tax me later bucket, or tax me never. And it doesn't matter if you got $2 or $2 billion or $200 billion. These are the only three places where that money can be located. And you can see here that TB's tax positioning, she is heavily allocated to the tax me now and tax me later bucket. But what about eliminating taxes? Well, she's got $0 in the tax me never bucket. And that's a big problem, especially as we head into a higher tax rate environment. I don't see very good tax diversification here at all. And so I think, we're going to get into this a little bit later and helping her to rearrange this portfolio and getting a little bit better on the tax positioning. As far as the tax me now bucket, $148,000, just for our audience to know what is the ideal balance to have in each one of these buckets. Well, the tax me now is pretty easy. Just take 6 months of whatever your monthly expenses are and multiply that dollar figure by 6. And that should be your target for the tax me now bucket. And then the tax me later bucket should be what that balance is when you take your RMDs out at RMD age and making sure that RMD matches your standard deduction. So whatever your standard deduction is, that RMD is less than that standard deduction. So that depends, obviously, whether you're married or single. In this case, TB's single, so she'll have a slightly lower standard deduction than those who are married. So again, we'll take a look at this in a little bit. In terms of the cost of the portfolio, she's got index funds that have zero expense ratio. So that's great. But she does have a layer of fees on top of that, which is being charged about 75 basis points annually. So, I guess the question is, what is she getting for that fee? Is the advisor really delivering the value? I mean, how hard are index funds to manage, honestly? You come up with an asset allocation, that's your target, and you rebalance periodically. There's not much work to be done in that regard. So 75 basis points seems pretty high. And then two, as we looked earlier, where's the help with the tax positioning? I don't see any sort of advice or guidance being given in that regard, and that's a pretty big and significant deal. So in terms of cost, I guess that'll be something TB has to take up with her advisor. Maybe renegotiate those fees or see if you can eliminate them. In terms of the portfolio's risk, she's got 84% allocation to stocks, 16% to bonds. That's pretty risky. In terms of her age group, she's 63, and she did consider herself, I think she said she was a moderate risk taker. This portfolio is definitely on the aggressive side. So I would say some work needs to be done in terms of tweaking the portfolio's risk character and making sure that it's aligned with how you've described yourself. In terms of the portfolio's diversification, again, she's got exposure to stocks, to bonds. That's good. But look at those other missing asset classes. No real estate, no commodities, no cash. Those are major asset classes that well-diversified portfolios should have exposure to. So I would say that that's an area that certainly merits attention. In terms of performance, the one-year return was negative 9.26%. And these are index funds, so she's going to match that index benchmark. Now, in terms of looking at this in terms of dollars, what does that mean? What does that translate into? I think this really helps you understand how much money is at stake. And she lost over $70,000 over the past year. Of course, this is unrealized on paper due to that pullback in her portfolio. So again, I think that's why having a margin of safety that's adequate and making sure that these losses don't escalate into something much deeper or bigger. So what do I like about this portfolio? First of all, it's built on a strong foundation of index funds. That should be the foundation for all investment portfolios, in my opinion. That includes index ETFs, if they're available. Also, I like the fact that there's no expense ratio on those funds. That's pretty cool. You don't see that very often. And certainly no expense ratios is even better than low expense ratios. But of course, as we pointed out, she is paying a fee to an advisor on top of that. So what are some of the potential pitfalls or problems with this portfolio that I've come across, that I see? Well, first of all, diversification clearly needs work. She's got stocks and bonds, but she's got no exposure to those other major asset classes that we highlighted, like real estate or commodities or cash. As far as real estate and commodities, a couple ETF tickers, if they're even available, which I don't think they are in her 401k plan, but for those wondering, REET is the ticker symbol for a global real estate ETF, what I would consider a good low-cost core position to the asset class real estate. And then ticker symbol SDCI, which invests in a basket of different commodities that would also fall in the same type of category in terms of a core asset class type of position to commodities. Again, that ticker symbol SDCI. So something like that would certainly help this portfolio in terms of diversification. And of course, if you don't have that, talk to your employer and ask them to add some of these, maybe some index funds that touch those areas. As we covered, no margin of safety. This portfolio is way too risky for someone 7 years away from retirement, especially if there's a big pullback in financial markets, any further than they've already pulled back. And then not enough money in her tax-free bucket. And I want to touch on that in a second. And then, of course, having a written investment policy statement. This has been something that's consistently missing from self-directed investors, but I'm surprised she's got an advisor. So where is the written investment policy statement? I mean, that's like, whoa. If your advisor hasn't given you that, then I would certainly immediately get in touch with them and say, hey, where's my written investment policy statement? I want it. Obviously, she's paying a fee. That's something that will tell her what her target asset allocation should be, what types of investments that she's going to use to get that exposure. And then also you can describe what types of investments are off limits, what areas that you don't want to invest in or don't want to touch. So that's your framework for investing. So that's very important for all investors. So how do we improve this portfolio? Well, there's a couple of things. The first thing that really jumps at me is there's no money in her tax me never bucket. That's the Roth 401k and Roth IRA. Now, she is contributing very aggressively to that 401k plan. So in other words, she's filling up that tax me later bucket, but she's not eliminating the taxes. And the great Milt Friedman once said that many people want the government to protect the consumer. A much more urgent problem, though, is to protect the consumer from the government. So when we shift money from our taxable and tax-deferred bucket into the tax me never bucket through Roth IRA contributions or Roth conversions, what we're doing is we're protecting the consumer from the government. So remember that. You pay tax once and never again. And in a rising rate tax environment like we're heading into, that's exactly what everybody should be doing, sheltering themselves from the tsunami of higher tax rates. So if she never met Ron DeLegge in the Portfolio Makeover and she just kept doing what she's doing right now, contributing aggressively to her 401k plan, she's going to have around $1.3 million by the time she hits 70 when she retires. And here's the problem. At age 73 is when our RMDs kick in. And in year one, her RMD, I estimate, is going to be around $43,000, which is way above her standard deduction. Now, that's bad. Plus, it's going to guarantee reductions in her Social Security benefits due to taxes on her Social Security check. So 2 strikes. And so she's got the next 7 years to fix these problems. And this is, as I see it, is the way to do it. Stop the 401k contributions, shift that into the Roth 401k or Roth IRA. Again, if the Roth 401k is not available, then you'll do Roth IRA. If it is available, Roth 401k, then you'll want to do that. It's got a higher contribution limit. And then look at shifting some of those 401k assets into the tax me never bucket by way of Roth IRA conversions. And again, like I said, she's got the next 7 years to fix this. And if she can, I see no reason why she can't get both her RMD and her Social Security 100% tax-free. And that's a beautiful thing. And also by diverting all that future savings to her tax-free bucket, the thing here is if she can also contribute. Actually, I forgot to mention that there is a limit, there is a cap. If she goes by the way of Roth IRA contributions, she just needs to make sure that she stays under that $153,000 adjusted gross income level. Because if she goes above that as a single, then she is phased out of doing Roth IRA contributions. So again, she's got some homework to figure out if the Roth 401k is available. If not, then put Roth IRA on the table. And that's pretty much it. Add a margin of safety cushion. You can go to etfguide.com and have help with calculating what your margin of safety amount should be and give you a target. And then you can also have some help with implementing that, as well as investments that meet the minimum standard of safety. That'll be included there. So that's about it. Great job, TB. Thank you for joining us on today's program and sharing your portfolio details. I think you're well on your way to having a stable retirement and a stable investment portfolio that lasts you deep into retirement and hopefully for the rest of your life. So that does it for today's episode of Portfolio Makeover. What about you? Do you want to get a portfolio makeover? Well, you can get in touch with me. Hit the link below if you'd like to book a one-on-one, and I'll give you some observations about what I see about your investment portfolio, what I like, what I don't like, and what can be improved. And who knows, maybe we can graduate you and get you onto the program and share your portfolio details with the audience. Well, that does it for today's episode of Portfolio Makeover. I'm Ron DeLegge. Don't forget to subscribe to ETF Guide TV. We'll catch you next time.